all principals, managers, other staff and articles to today's study circle meeting on Income Tax Act 2025 from section 31 to 41 conducted by Miss Anusha, Medar. Without further delay, let's start the session.
Good afternoon everyone. Before getting to the topic, let me revise from the section 1 to section 30. Section 1. You can refer the notes also. Section 1. Title, extent and commencement of the Act. Section 2. Definition. Section 3. Definition of the tax year. Section 4. Charging section. Section 5. Scope of total income. Section 6. Residential status. Section 7. Income deemed to be received and dividend received in the tax year. Section 8. Income on the receipt of the capital asset. Section 9. Income accrue and arise in India. Section 10. Apportionment of the income between the spouse as per the Portuguese Civil Code Act. Section 11. Income do not form the part of the total income. Section 12. Income do not form the part of the total income in case of the political party. Section 13. Heads of income. Section 14. Income forming the part of the total income. Section 15. Salary. Section 16. Income from the salary. Section 17. Perquisite. Section 18. Profit in the lieu of the salary. Section 19. Deduction from the salary. Section 20. Income from house property. Section 21. Determination of the annual value. Section 22. Deduction from the house property. Section 23. Arrears of the rent and the unrealized rent received. Section 24. Regarding property of the co-ownership. Section 25. Income interpretation. Section 26. Income from the PGBP charging section. Section 27. Computation aspects of the PGBP. Section 28 is regarding remuneration, rent rates, repairs and the insurance. Section 29 deduction in case of the employee welfare. Section 30 certain premium. The section 31 to 41 largely deals with the deduction and the computation aspects of the PGBP. The primary objective of this section is to determine the net taxable income by specifying which expenses are deductible, how the assets are depreciated and what amounts are deemed as a taxable income. There comes section 31. Deduction for the bad debts and the provision for the bad and the doubtful debt. If the specified assessee made a provision for the bad debt, it shall be allowed as a deduction provided the specified assessee is a scheduled bank other than the bank incorporated by or under the law of the country outside the India, or non-scheduled bank or cooperative bank other than primary agricultural credit society or the primary agricultural rural development bank. The amount of the deduction is, it shall not be more than 8.5% of the total income before giving the deduction under this clause or the chapter 8A. Further, the additional amount up to 10% shall be allowed to the on an aggregate average advances made to the rural branches computed as may be prescribed. Further, the assessee mentioned in the clause A and the B, that is scheduled bank and the non-scheduled bank, may deduct the excess amount provided it shall not be more than the amount on the income of redemption of the security framed by the central government. Then the bank incorporated by under the law of the country outside the India, that is the foreign bank or the public financial institute, state financial corporation or non-banking financial company, may deduct not more than 5% of the total income before giving the deduction under this clause or chapter 8. As per the subsection 2 of the section 31 state that if the debt was previously written off and allowed as a deduction and later on it is recovered, the amount of the recovery is treated as a income in the year of the recovery itself. Then come the section 32, other deduction. The following amount shall be allowed as a deduction, that is bonus or the commission paid to the employee in respect of the service rendered. interest paid in respect of the capital borrowed, and such capital shall be used wholly for the purpose of the business. Then the contribution paid by the public financial institute to a credit guarantee fund trust for the small industry, the central government may by notification specify. The pro rata amount of the discount on the zero coupon bond having regard to the period of the life of such a asset calculated as may be prescribed. Then the amount carried to the special reserve created and the maintained by the specified entity like public financial institutes and the banking company. Then comes section 33, deduction for the depreciation. As per section 33 subsection 1 state that a deduction in respect of the depreciation shall be allowed in case of the building, plant and the machinery, furniture, intangible asset except the goodwill, only if the following conditions are satisfied. The asset shall be wholly or the partly owned by the assessee, and the asset shall be used wholly for the purpose of the business. Further, the deduction under this section will be restricted to 50% of the prescribed rate, provided the asset is acquired during the year and put to use for more than 180 days. In the tax 180 days. This is the depreciation chart as per the Income Tax Act, the asset and the rate of depreciation. In case of the building, commercial building 10%, residential building 5%, wooden structure 40%, furnitures and the fixture 10%, intangible asset except the goodwill 25%. In case of the plant and the machinery, computer 40%. Books, whether it is a library books or the other books 40%, aircraft 40%, ships 20%, pollution control equipment 40%, other than the mentioned above will be 15%. Then come additional depreciation. The additional deduction under the section 33 subsection 8 in respect of the depreciation of the new plant and the machinery will be allowed when the assessee is engaged in the business of the manufacturing or the production of the article or transmission or distribution of the power, and this new plant and the machinery shall be put to use by the assessee for the purpose of business only. However, additional deduction in respect of the depreciation shall be 20% of the actual cost of the plant and the machinery acquired and the put to use for more than 180 days. In case of the less than 180 days, 10% will be allowed. Section 34, general condition for the allowable deduction. Any expenditure not covered from the section 28 to 31, not in the capital and the personal nature shall be allowed as a deduction, provided it shall be wholly used for the purpose of the business, except the following: expenditure incurred for any purpose which is an offence or prohibited by the law. Second, expenditure relating to the CSR as referred under the section 135 of the Companies Act. Expenditure incurred on advertisement in pamphlets or other similar publication by the political party. Section 35. Amount not deductible in certain circumstances. Irrespective of the any provision, following amount shall be allowed as a deduction. First one, failure to deduct or pay the TDS. 30% following amount shall not be allowed as a deduction in computing the income. First one, failure to deduct or pay the TDS. 30% of the any sum payable to the residents will be disallowed if the TDS is not deducted, or if deducted not paid within the due date specified under the section 263. Then the TDS is failure regarding the interest, royalty, technical fee payable outside the India or the non-resident lead to disallowances with the allowances made in the year of the payment. Then come any expenditure incurred by the firm, such as remuneration to the non-working partner will be disallowed, interest to the partner exceeding the 12% per annum will be disallowed, remuneration or the interest not authorized by the partnership deed will be disallowed. If the remuneration is authorized by the partnership deed exceeding the amount computed will be disallowed. That is, on first 6 lakh of the book profit or the losses 90% or 3 lakh, whichever is the higher, on balance book profit 60%. To understand this, take an example. Partnership deed authorizes the remuneration 12 lakh to the partner. The book profit of the firm is 10 lakh. Now we are required to calculate the allowable remuneration. On first 6 lakh of the book profit we have at the rate of 90%, it come to 5.4 lakh or the 3 lakh, whichever is the higher, that is 5.4 lakh. On the balance of the book profit, we are required to the required rate is 60%, that is 4 lakh into 60%, it will be 2.4 lakh. Total allowable remuneration as per the Income Tax Act will be 5.4 lakh plus 2.4 lakh, 7.8 lakh, but authorized by the partnership deed is 12 lakh. Therefore, the excess amount, that's the difference between the authorized by the deed and the allowable under the law, 4.2 lakh will be disallowed. Then comes section 36, expenses of the payment not deductible in certain circumstances. Disallowances of excessive payment. If the assessee makes the payment for the goods, services or the facility to a specified person, that is a director, partners of the firm or the relative, will be deemed as a excessive or the unreasonable comparing with the market value, then the excess amount will be disallowed by the assessing officer. Then the cash payment limitation. Any payment or the aggregate payment made to a person in a day exceed 10,000 and it is made not through any banking or the online mode, such amount will be disallowed. Further, the amount 10,000 shall be read as 35,000 in case a payment is made for playing, hiring, leasing of the good carriage. Section 37, certain deduction on actual payment basis. Specified payments such as taxes, duty, cess, surcharge, fee by whatever name called, contribution to employer to the provident fund, superannuation fund, gratuity or any fund for the welfare of the employee, amount payable to Indian Railway for the use of the railway asset, any interest on the loans, advances, borrowing from specified financial institutions as per the terms and the condition. Any amount payable to MSME within the limit specified under the MSME Act 2006 will be allowed only in the financial year as per the actual payment basis. Certain sum deemed as a PGBP. Section 38, recapture of the deduction. If the deduction was allowed in the previous year regarding the losses, expenditure or the liability, and assessee subsequently recover any amount regarding the losses, expenditure or the liability, that will be treated as a income in the year of the recovery. Sale of the asset. If the asset which was previously used for the purpose of the business was sold and the sale plus the scrap value exceed the WDV, the excess amount will be treated as an income in the year of the recovery. In case of scientific research asset, if the asset representing capital expenditure on scientific research are sold without being sold for other purpose, any proceeding leading to the recovery of the previously allowed deductions are taxed. These provisions will apply even if the business or the profession is no longer in existence during the year of the recovery. Then comes section 39, computation of the actual cost. The actual cost of the asset used for the purpose of business or the profession shall be the actual cost to the assessee by reducing the following amount. A part of the cost of the asset, if any, met by the person or the authority directly or indirectly, goods and the service tax paid in respect of which ITC has been claimed and allowed under the relevant law, any subsidy received directly or indirectly from the central government, state government or any authority. Above these conditions shall be deducted while computing the income under the actual cost. Section 40, special provision for computation of the cost of acquisition of the certain asset. For computing the income under PGBP, when the capital asset become the stock in the trade, the cost of acquisition is determined as follows. In case of the amalgamation, cost is equal to cost of acquisition in the hand of the amalgamating company. In case of the gift, will, trust or the HUF partition, cost equal to cost in the hand of the previous owner. Here, cost of the acquisition include original cost of the asset of the previous owner and cost of the improvement if any, and expenditure incurred in connection with the transfer if applicable. Then comes section 41, written down value of the depreciable asset. This section will explain how to calculate WDV of the asset. WDV is equal to actual cost minus depreciation already allowed. As per Income Tax Act, depreciation is always calculated on the WDV basis, not on original cost. In case of the block of the asset, WDV is calculated in the following manner. This is the formula: A minus D plus B minus C minus E, where A is the WDV of block of the asset in the previous year, B is the purchase of the new asset, C is the sale of the asset during the year, D is the depreciation allowed in the previous year, E is the adjustment regarding the slump sale. For example, opening WDV is a 5 lakh, new asset purchase for 2 lakh, asset sold 1.2 lakh, depreciation for the last year 50,000, slump sale adjustment is a nil. Now we are required to calculate the WDV value of the asset. Opening WDV, that is 5 lakh, less we have to deduct the depreciation if any allowed in the previous year, that is 50,000. Then we arrive at the A minus D, that is 4.5 lakh. Then we have to add, is there any purchase during the year, that is 2 lakh. We have to deduct, is there any sale during the year, that is 1.2 lakh, less slump sale adjustment if any. There is no slump sale, it will be 0. We arrive at the final WDV, that is 5.3 lakh. On this final WDV, while applying the rates, we have to calculate the depreciation and take a deduction. This is a quick reference comparing the old and the new section of the Income Tax Act 1961 and 2025 respectively. Thank you.
As we come to the end of the session, I would like to thank Ms. Anusha for her wonderful session, and I would also like to thank principals for conducting such a study circle meeting. Thank you all.